What's up, everybody? Mike here again. I want to talk about Seritage again. Now, as I hold this stock, my ideas are changing over time. Now, if you watch any of the videos or read stuff about the investment thesis on Seritage, most of it's geared towards like a long-term view. So the general idea is that they're going to develop these premier properties, and then over 5 or 10 years, they're going to have massive cash flows, which will end up pushing the stock value way up. Now, I'm actually developing more of a short-term view here, based on a catalyst that is going to occur in the next 12 months. And I believe that this is a fairly binary situation where the company is either going to fail at this or they're going to succeed, and the stock price is going to act accordingly. So I'll start out by talking about the general long-term thesis, just a quick overview, and then I'll talk about my new view on this company later on. So feel free to skip ahead if you just want to hear the short-term idea. But for people who maybe aren't familiar with Seritage or what the argument is here, really quickly, the company was built on the back of all these old Sears stores that they own, and what they would do is they would lease the property to Sears for $5-6 a square foot, and that was just supposed to be the business model. But what happened was Sears went bankrupt, and so Seritage was left holding all these Sears properties that weren't generating any cash flow. So they had to quickly change directions and look to do other things with the property. So what they're doing now is they've identified basically three big buckets of properties that they own, and they're doing different things with them. So one bucket is their premier properties. So what they're doing is they're taking, and this is the crux of the investment thesis. So they are taking a small handful of these properties that are in prime locations. They're ratcheting up, building them up into these big developments, with retail, commercial, and residential spaces. And so they're vastly increasing the square footage on those pieces of property, and the price per square foot is vastly higher. And just to give you an example, so they've recently leased a space to Amazon for over $60 a square foot in one of these new properties. And so again, compared to the price Sears was paying, which was single digits, that's sort of the idea of the long-term view on this. Now, the other two buckets are they are releasing some of the properties just as is, and those are coming in on the teens price per square foot, so they're releasing them to other retailers. And then there's a third bucket, which is the basically this non-core holding, they call it. And so what they're doing is they're using that to fund their cash flow. So they're selling off these properties and using the cash flow from that to fund the redevelopment of the good properties, and also to fill the cash flow needs while they are cash flow negative. So the cash flow negative right now, that's one of the big problems with the stock. And so basically the big risk here from a long-term perspective is, one, they either don't sell enough properties to fund their cash needs, and then they just grind to a halt, or the cash burn keeps up for multiple years, and they don't quite get to the positive cash flow that they're looking to try and get to in the sort of next few years. And the negative cash flow continues, and they basically just erode away their the net asset value. And just quickly on the net asset value, this is sort of a crux piece of one of the value investor views. I've seen a few different estimates on the value of all their assets put together, and they all seem to land between 3 to 4 billion in net asset value. So if you take that, let's say you take the bottom end view of that, which is the 3 billion, and you extract the amount of debt that they owe. They have one loan, and it's to Berkshire and now they owe 1.44 billion. If you extract the 1.44 billion, the remaining asset value is over 1.5 billion. And if you take the 1.5 billion and compare it to the actual stock price, I believe at $8 stock price, or $7.96 where it closed today, the market cap is $348. So you can see that the market cap versus the actual theoretical value of the current holdings is, it's vastly mispriced, right? So you're paying something like 22 cents for every $1 in real estate assets. And that's exclusive. That doesn't even include the development potential of these premier properties that they have. So, there's the margin of safety idea. There is the upside potential of the cash flows. So those are the two main cruxes. Okay, so now on to the short-term view on this one. So one of the things that has happened recently is that Seritage has come to an agreement with Berkshire to extend the debt beyond its expiry in July 2023. Okay, so this debt that they had, this 1.44 billion, is due in July next year. And I think what's happening is the market is worrying about that. And that's holding the price down. Now, the other worries are legitimate too. The cash flow burn, will they be able to deal with that? But I think that there's a short-term headwind here that's caused by this debt restructure or this debt problem. So what Berkshire has agreed with them is that if they can get the debt down to 800 million by that time, by July next year, they will get another 2-year extension on the debt. And so the company has now put 700 million up of their properties in this non-core portfolio up for sale in order to use the funds to pay that debt down to the 800 million. So I see that there's a short-term binary outcome here where if they are able to achieve their plan and sell these properties, then what will happen is the stock will respond to the relief that's allowed by this extension on the debt. So I think that that's one of the things holding the stock price down. And then on the other side, if they don't, so the binary outcome is they do sell 700 million and pay the debt down, or they don't. And so if they do, I believe that's going to propel the stock upward. If they don't, then what happens is, as far as I can tell, now if this is wrong or if you think that I'm missing something, please write it in the comments. I really appreciate that. But I think then what happens is that Berkshire becomes the controlling factor in this conversation. So they can demand their debt be repaid, and so that they can either do maybe one of two main things. One is they can force a liquidation, force Seritage to just fire sale the company as a whole, or fire sell pieces so they can get their debt back. They can also maybe come to an agreement where Berkshire owns some of the properties, they hand some of them over, but I don't think that Berkshire is going to want that kind of headache. That's just my guess. Or the other thing that can happen is Uncle Warren can say, okay, I'll extend the debt, but here are my terms, and he'll get a very Warren-friendly deal out of that, which actually would be good, I think, because it would also give some relief to the company and give them some more time to develop their properties. So what I've done here is I've actually created 3 different potential outcomes that I see happening, let's say, within the next 12 months. 2 of them are what happens if they don't get to that debt requirement, and 1 if they do. So one of the things going on here is that theoretically, if you pay debt down, the equity value should increase by that amount, assuming the enterprise value is accurate at the time, right? So if we have a situation where, let's say, Seritage pays down, they sell 250 million of properties, they pay their debt down by 200 million. That would mean that the debt lands in 12 months at 1240, which means that assuming the enterprise value stays the same, the market cap should actually increase to about 550. And what happens in that scenario is basically, let's say Warren decides to be nasty about this, and he says, you need to sell the company as fast as you can to give me my money back. You still have a net asset value of 2750. That includes the cash burn that will happen over the next 12 months, maybe 200 million, and the loss on that on the sales that they've made during the year. So as long as they can get 1788 in enterprise value from selling the whole company, then they can, then the market cap should be worth, the stock value should still be worth 550. That leaves $1 billion in net asset value on the table, right? So let's say you had a fire sale and you had almost $3 billion in assets, sell them for $2 billion or 1.8 in this case. That's how that situation plays out. And so let's say they sell a few more. Scenario 2, they sell a few more. They reduce the debt by $400 million, but don't quite get to the debt extension. Then theoretically, in that situation, the market cap should increase by over 100%, because that $400 million paid on the debt should be transferred to the market cap side. Now, again, this is everything else being equal, assuming the current market cap is a fair value and all this kind of stuff. The stock will bounce around between now and then. This is just a theoretical exercise saying if you're paying debt down, that actually adds value, even if you end up screwing it up in the end. And then so the last scenario, let's say they succeed. Let's say the company sells their $700 million, they take a bit of a haircut, they pay down the debt by the appropriate amount, get it to $800 million, get the 2-year extension from Berkshire. I would say in that scenario, let's assume again the 1.8 billion enterprise value is correct. The upside is nearly 200% in that scenario. And I think it could be even higher, because at that point you have the dark cloud of the debt problem removed, and you might even get more upside from that. So you might get a double whammy here. You get the one side where the debt is virtually cut in half, and that frees up the stock, and then the other side is the debt cloud gets removed, and you get the relief in the stock price as well, the relief move from the stock price as well. So I guess in summary, my view here is that there's going to be an outcome here in the next 12 months. They're either going to make it or they won't. And if they make it, the upside is, I think it's at least 200. I think it could go up higher than that. And if they don't, I still think they have enough assets that even if this company is liquidated in a fire sale, they'll still, the equity is still substantially undervalued at this point, especially after paying down even more of the debt by then. So I'm looking at this as a fairly good scenario. Now, I should say that this only applies at certain price levels, right? If it was trading at $13 or $14, that changes this calculation pretty significantly. So I'm just looking at this as we're seeing a big dip in the stock price and saying, oh, this might create a fairly good risk-reward opportunity. And on top of that, I have added a few options, not many because they're poorly priced, but I did buy some January 23 calls at $10, assuming that if they get to a good pay down in their debt by then, the stock will react pretty positively by the end of the year. So anyway, that's my view for the day on Seritage. Let me know if you have any comments. If you think that I'm totally off base here, let me know why so I can look into it. But yeah, thanks for watching. If you made it this far, we'll see you in the next video.